A few years ago, a $600 car payment sounded ridiculous. Today it's normal. In fact, the average new car payment in America is now over $700 per month, and millions of people are making payments for 6, 7, even 8 years. Think about that. You're paying for a car longer than many people stay at the same job. And here's the scary part. Most people don't realize how much damage it's doing to their finances until it's too late. Because the problem isn't the payment, the problem is everything that comes with it: the interest, the insurance, the depreciation, the repairs after the warranty expires, and the fact that one bad car loan can keep you financially stuck for years. Today, I'm going to show you exactly why car payments are keeping so many Americans broke, and more importantly, how to avoid becoming one of them. Because the difference between financial freedom and financial stress might be sitting in your driveway right now. Section 1. The new normal isn't normal. Let's start with a simple question. When did $700 a month become acceptable for transportation? Most Americans don't wake up wanting a huge payment. It happens slowly. You walk into a dealership. You find a vehicle you like. The payment comes back too high. The salesperson says, "What if we stretch the loan a little longer?" The payment drops. Problem solved. Except it isn't. Because you're not paying less. You're paying longer. That's how people end up with 72-month loans, 84-month loans, sometimes even longer. A $40,000 vehicle suddenly feels affordable because the payment fits the monthly budget. But here's what's actually happening. You're committing future income before you've earned it. For the next 6 or 7 years, part of every paycheck already belongs to the bank. Before you buy groceries, before you save for retirement, before you take a vacation, before you build wealth, the bank gets paid first. And most people don't realize how limiting that becomes. Section 2, the depreciation hammer. Now let's talk about the part nobody likes discussing: depreciation. The moment you drive most vehicles off the lot, they're worth less than what you paid. Sometimes dramatically less. Imagine buying a $45,000 SUV. 2 years later, it's worth $32,000. You've lost $13,000. And unlike a mortgage, that money isn't building equity. It's disappearing. People often focus entirely on the monthly payment and ignore the value loss happening in the background. But depreciation is usually the largest ownership expense most buyers will ever experience. The scary part? Many owners don't even know what's happening. They're making payments faithfully every month while the vehicle loses value faster than the loan balance declines, which creates another problem: negative equity. Section 3. The underwater trap. Negative equity is one of the biggest financial traps in the automotive world. It's simple. You owe more than the vehicle is worth. Let's say your payoff is $30,000. Your vehicle is worth $24,000. You have $6,000 of negative equity. That $6,000 doesn't disappear. When you buy another vehicle, dealerships often roll it into the next loan. Now, your new loan starts underwater. Many people repeat this cycle over and over. Every trade makes the problem worse. The debt grows, the payment grows, the loan term grows. And suddenly someone earning a decent income feels permanently broke. Not because they don't work hard, because they're carrying old vehicle debt from years ago. This happens every day, and most buyers never see it coming. One thing to keep in mind: truck repairs can get expensive fast. If you want to protect yourself, we've added a trusted warranty provider in the description where you can check coverage and pricing. But if you think the payment is the biggest expense of owning a vehicle, wait until you see what happens after the warranty expires. Because this next part is where many owners get hit twice. Once by the payment, and again by the repair bills. Section 4. The repair bill double punch. Modern vehicles are incredible. They're safer, more comfortable, more advanced, but they're also more expensive to repair. A single touchscreen can cost thousands. Electronic modules, sensors, cameras, adaptive cruise systems, lane keep assist systems, modern transmissions, modern turbochargers. None of it is cheap. And here's the problem. Many people buy vehicles based entirely on whether they can afford the monthly payment. They never ask whether they can afford ownership. There's a difference. A $700 payment plus a $3,000 repair is a completely different financial reality. That's why smart buyers don't ask, what can I afford monthly? They ask, what can I comfortably own? Those are two very different questions. Section 5, the insurance shock. Another expense that's crushing budgets is insurance. Many buyers are shocked when they get the quote, especially on newer vehicles, especially on EVs, especially on performance vehicles. The payment looked manageable. Then the insurance bill arrived, an extra $200, $300, sometimes even more. Suddenly, that affordable vehicle isn't affordable anymore. And unlike optional upgrades, insurance isn't negotiable. You need it. Which is why every buyer should get insurance quotes before purchasing a vehicle, not after, because the total ownership cost matters far more than the payment alone. Section 6, how to escape the payment trap. You don't need to be rich to avoid this. You simply need a different strategy. First, buy less vehicle than the bank says you can afford. Banks approve people for loans they shouldn't take every single day. Second, keep vehicles longer. The fastest path to financial freedom, isn't it? Constantly upgrading. It's driving a paid-off vehicle. Third, avoid rolling negative equity into another loan. If you're underwater, solve the problem before buying something else. Fourth, focus on total ownership cost. Payment, insurance, repairs, fuel, depreciation. All of it matters. And finally, stop shopping based on payment. Shop based on value. The payment is just a symptom. The actual price is what matters. Here's the truth. A car payment doesn't automatically make you broke, but an oversized payment absolutely can, especially when it's combined with depreciation, insurance, interest, repairs, and negative equity. The buyers who build wealth aren't always driving luxury vehicles. They're usually driving vehicles that give them financial flexibility, vehicles that allow them to save, invest, and keep more of their paycheck. The goal isn't to impress people at a stoplight. The goal is financial freedom. Because nobody ever became wealthy by making giant payments on depreciating assets. If you found this helpful, subscribe to Bidding for Autos. And in the next video, I'm going to show you the dealer tricks that quietly add thousands of dollars to your loan before you ever leave the finance office. You won't want to miss that one. If you want more like this, subscribe and watch this next.